couple of things that you could do here is you can view this by right-clicking on this, and you could see the details, and it'll show you our details page. We'll get into this in a little bit. Or you can right-click and add this to your report. So we'll add that to our reports. And we'll go look at it in my reports. And here's what we just added here. Let's look at and let's look at one more thing. You could also type in a different symbol, Intel, and see which strategies did the best in Intel. So let's go to All Reports tab. Literally thousands of reports on various symbols. You could scroll through it with the slider, or you could type in a I for IWM or IW to get through it quickly. So let's look at an IWM short call buy right, or that's IWF. I'm sorry. Let's look at an IWM short call buy right. We'll leave that hedged on and generate a report. So what this is saying is it's sorted by Sharpe ratio, and the best Sharpe ratio, Sharpe by the way is the annual return divided less risk free rate divided by volatility of the returns. The best one is selling the month 3 delta 50 and then exiting when that delta 50 gets down to 13 delta. You could sort these by strategy name and see that we go from a 10 delta, 15, 20, all the way up to a 50 delta. So we could sort by Sharpe ratio, sort by annual return, and we'll talk about these other column headers in a moment. So back to Sharpe. And then if you want to look at how these performed, the details, you right-click, show details. So what we're looking at here is the strategy that we just looked at. This is a graph starting with $1,000, how your investment would have done. You would have ended up with $2,190. Again, this is hedge profit. If you want to see option profit alone, it looks much different, and both you could compare, or you could just show the stock profit. So the stock profit, this is handy because you could see how it compares to the strategies. So the stock would have done better than the blue, but worse than the red, light red. And then we show you all the monthly returns here. So this is a stock monthly returns. If you want to go back to the option monthly returns, you could see those, or the hedged monthly returns. So this is interesting that the hedged did better than the stock returns alone. So that's, you could also overlay other stocks. That's the stock price. Or you could overlay the implied volatility. So here's what happened to the implied volatility in IWM. And then the statistics, Sharpe ratio, annualized return, return volatility, how much you got from an initial $1,000 investment, what's your average monthly return, a drawdown. Let's just talk about that real quick. Let's take off the stock price and take off the overlay of the graph for the stock price and short-term volatility, and then we'll just look alone at the profit from hedge. A drawdown is the farthest drawdown and how long it took to recover from that. So this was 63% drawdown, and it took 439 days to recover from it. The average holding period for this is 51. Correlation to the stock, you would imagine, is quite high. Buy rates tend to be. The annual stock, and then you could compare the stock return, stock volatility to the buy right overlay. So that's a good look at the buy right. Let's go look at a put spread. So here's a put spread, and we'll stay with IWM. So we probably don't want to have a hedged put spread. We'll want to do just the options alone. So we'll generate the report again. And so you'll notice that these are all negative returns. Since IWM has been up, a put spread is short delta, so it's going to be losing money. So the one that lost the least was the month 4 50-40 put spread. So buying a 50 delta put, selling a 40 delta put, and this exit strategy is holding at 95 days, and you can see some of the other exit strategies here. So again, right click to show details. We've already kind of talked about this. So what we're going to look at now is you would do a put spread in years that where the market was down. So let's look at 2008 and regenerate the report. You'll see that 2008 comes up here. Which put spread did the best in 2008? Well, an out of the money put spread had more leverage, so that did the best. So that what this is the, and we could show the details. We're kind of looking at here. This went up the most in 2008, and it's the month 3 out of the money. So 2010 hold to expiration, or a RIP value. A RIP value is something that ORATS has developed to get a stable price exit for each stock. You could think of it as the value of a 25 delta option with 45 days to expiration. We use that to exit certain strategies, and that theoretical value we took 50% of. That's a longer topic, but I'll just introduce it here. So another thing that we want to look at is looking at particular quarters. So we want to find out what's the best strategy when the IWM was down. So we look at IWM returns here, and I'm just scrolling down. So every time that the IWM was down more than 7%, I can look how all the strategies did just in those quarters, and I right click and populate the quarters. So what this, you may have noticed, highlights these quarters. You could do these manually, or it's handy to have that functionality. So let's regenerate the report, and now you might notice that the period returns, 2007 quarter 4, IWM was down, and on these other quarters, IWM was down. So let's see which put spread did the best in that time period. Again, pretty similar. The most out of the money has the most leverage, month 1, and exiting at a delta 5. So that's an interesting result here. We're going to not go over the toes. That's a more advanced topic, as is the RIP. So we're going to go back to our slides and make sure that we've gone over everything in the presentation, which we have. So the other things that we want to do are scan and save position. So that's a handy feature, again, of the desktop implementer. So let's say we do put on this spread. So we've already shown the details. We could add it to my reports. And let's say we like the strategy, so we're going to use this for protection. What are the options currently for this IWM put spread? So leg 1, leg 2, leg 1, leg 2, they're highlighted, so there are, you can see 3 of the many different possibilities here. So what are these strategies? So here's the long put is the 11 delta, so we give ourselves a range. And the short put is the 6 delta, so you can see how far out of the money that is. So one of the things that we want to take you through is the positions tab. So let's just say we save these positions, and it'll save it in my documents or wherever you want to save it. and then we could go over to positions. So let's say you have these positions on. So it loads these in, and it will, and when you press update the positions, it'll say whether it's an exit yet. Remember that this particular strategy exited when the delta of the 20 delta got to a 5. This will manage that for you. Are these exits? No, we just made it, but tomorrow they may be, or in a week they might be exits. So it would say, hey, if you're going to follow this backtest strategy, it's time to get out. And it tells you the profit. The profit is just where the commissions that you paid so far, since these option prices haven't moved since we traded them. So that's concludes our presentation. I hope you enjoy the implementer. Has a lot of very handy offerings and tools. If you have any questions, please contact me at orats.com.